We talked about what impacted the markets over 2021 and what may impact markets in 2022. Now let's see what some others are saying about where they think the market is headed in the context of a more detailed discussion of some of the possible headwinds and tailwinds we just finished reviewing. I mentioned that a healthy consumer might be a tailwind for the market this year. Here's why I think this could be the case. The share of GDP that comes from spending from within the US is just shades under 70%, which makes financial health of the American consumer an integral part of economic growth. This chart is an illustration of Americans' balance sheet coming into New Year. As you could see, assets owned by individuals have steadily risen since the depth of the pandemic in second quarter of 2020. To a level that is now higher than pre-pandemic levels. Meanwhile, consumer debt has stayed roughly the same throughout the same period, owing in part to government assistance programs throughout the pandemic period. When we take all this together, America's net worth has increased, which has put more spending power into the hands of the consumers, which may lead to higher economic activity. There is one more important element to increase spending. However, besides the money to spend, which is confidence about the future. In the past 2 years, we've seen that consumers who lack confidence in the near-term health of the economy or are concerned about the spread of COVID-19 infections are less likely to spend. Consumer confidence took a hit as 2021 came to a close, thanks to the Delta surge and accelerating inflation and the introduction of the Omicron variant. Corporate earnings will be another likely important determinant of stock market performance in 2022. After all, these are key factors in determining stock valuations in the long term. Overall, earnings in 2021 were strong, rebounding strongly from muted earnings during the pandemic months in 2020. As you can see from this chart, the third quarter was exceptionally strong, increasing 39.8%. Fourth quarter 2021 earnings growth is expected to be over 20%. These are big numbers that are not expected to be repeated. In fact, earning growth estimates are expected to narrow with a 2022 calendar year growth rate of just under 9%. At first glance, this may seem like a headwind rather than a tailwind for the market. But remember, markets are a discounting mechanism that looks 6 to 9 months ahead. So today's prices reflect the 22 forecast for corporate earning growth. However, a strong economy in 2022 could lay the ground for positive earning surprises in 2022. It is important to remember that forecasts or forward-looking statements are based on assumptions and they're subject to revision without any notice and may not materialize. And if we learned of anything during the past couple of years, it is that the outlook for the financial markets can actually change quickly. Inflation is an important economic indicator. Rising prices impact the entire economy. Too much inflation can hinder growth, while total inflation can be a sign of economic weakness. As the chart illustrates, inflation took a sharp turn higher last year from the norms of recent decades. The strong rebound from the pandemic-induced recession, coupled with labor shortages and supply chain bottlenecks, caused the prices of many goods and services to jump. Some economists also point to the combination of fiscal spending and accommodative monetary policy as a contributing factor to the acceleration of inflation that we see. Whatever the reason is, inflation has accelerated at a faster pace and persisted for much longer than originally anticipated by the Federal Reserve. Fed Chair Powell has admitted as much. Despite this admission, Powell still believes that inflation will recede in 2022, and the market have largely accepted this inflation narrative. So while unclogging the supply chain pipes will be a key development in 2022 to moderate inflation, wage growth pressures are likely to persist as a driver of continued inflation in this new year. We also included the rise in producer prices because they can indicate future increase in consumer prices since businesses often pass on some or all of the price increases to the consumer. Inflation may have a major influence on the performance of financial markets in 2022 since it could force the Fed to quicken the pace of its bond tapering program and change its plans for interest rates. In each of those instances, the Fed's action may impact bond yields and stock prices. Even if the Fed sticks to its schedule for tapering and interest rate hikes, the bond market may not sit idly by. Bond investors may start demanding higher yields to offset rising inflation, the effects of which could ripple into the stock market, especially among high valuation companies. During the past 2 years, there's been no greater influence on the stock market, at least on a short-term basis, than COVID-19. Increases in infections raise the prospect of economic restrictions, which causes temporary sell-offs, while declines in infections or new treatments help investor sentiment. With the emergence of Omicron and the prospect of an uptick in new infections, investors will be particularly sensitive to how well this risk is managed. As the chart indicates, we've seen defined surges of infections, the initial one in 2020 and that of the Delta variant in the third quarter of 2021. Of course, no one can predict the course of COVID-19 infections moving forward, but we've seen that markets get nervous when they spike. Economic forecasts surveyed by the Philadelphia Fed are painting a generally improving economy. While they have trimmed their GDP growth estimates for the final quarter of 2021 and the first quarter of 2022, they're projecting a stronger growth in the second half of 2022 than originally anticipated. On the labor front, they are very optimistic, calling for declining unemployment rates throughout the whole year and at much faster pace than they had earlier predicted. The labor market continued to strengthen over the course of 2021, with unemployment falling and wage growth accelerating. As we saw in the previous slide, unemployment is expected to fall further as the economy expands. A healthy employment picture has historically augured well for the economy. While wage growth is generally a positive development for the economy, it should be noted that the upswing in wages has been offset by a faster rise in prices, leaving many workers with lower spending power despite the strong wage growth. So what are some saying about forecasting the domestic equities in 2022? On average, there's an expectation of a modest gain from 2021 close. The forecast reflects the belief that stocks are unlikely to repeat their outsized gains, the one we saw in 2021, as well as we could see some headwinds that may impact corporate earnings and economic growth as well, such as inflation, supply chain disruptions, and the potential of new COVID-19 variants. Within this average forecast for modest return is a broad range of estimates from flat or slight decline to a much healthier gain. Of course, no one knows for sure what equities will do in 2022, and predictions at this stage are just that. Predictions, however, from analyst perspectives show that for the most part, Wall Street is generally optimistic. Like other images in this presentation, this image includes a forecast, so it is important to remember that forecasts again are based on assumptions and are subject to revisions over time. Financial, economic, political, regulatory, and in this instance, health issues may cause actual results differ from the expectations expressed in this forecast. So we've covered a lot of information, focusing most of our discussions on what drove the markets and what we expect to move the market over a short period. However, as we know, what can sometimes get lost with a short-term focus on the market is a consideration of the long term. This chart illustrates the value of investment discipline. Since 1950, we can see that one-year range of returns for stocks is quite wide, with yearly gains of up to 47% and yearly losses of up to 39%. As represented by the purple bar, bonds have much narrower performance, ranging from 43% to negative 8%. Finally, we see a hypothetical balanced portfolio of 50% stocks and 50% bonds, in which there are lower highs and higher lows. If we follow the performance of these three portfolios during the 5, 10, and 20-year rolling period, since 1950, by the way, we see that the range of returns narrows. In short, a balanced portfolio can help manage overall risk. The precise allocation among different asset classes will vary from one investor to another. That depends on their individual goals, time horizon, and of course, risk tolerance. Also keep in mind, asset allocation is an approach to help manage investment risk. Asset allocation does not guarantee against investment losses. In this illustration, stocks are represented by the S&P 500 Composite Index, which again is an unmanaged index that is considered representative of the overall U.S. stock market. Bonds are represented by the Strategas Ibexen Index for the period from 1950 to 2010 and the Bloomberg Aggregate Index from 2010 to 2020. Index performance, always keep in mind, is not indicative of past performance of a particular investment, and past performance does not guarantee future results, and individuals cannot invest directly in the index. The return of a principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than the original cost. So in my opinion, when it comes to the markets, there's superior and inferior. So inferior, in my opinion, is timing the markets, trying to capture the highs, avoid the lows, trying to navigate that sea. In my opinion, superior is a plan, But even more superior, in my opinion, than just a plan is a holistic plan. A holistic plan where everything in your situation is considered carefully. And the entire plan is designed in such a way that takes into account every detail of the things that concern you. So what can we conclude from this whole presentation and information that we gave you here? Is that it can try to predict, and we can all try to predict what's going to happen next. But ultimately, no one really knows. You could not have predicted COVID-19 if you wanted to. And you could not have predicted all the things that have happened in the past 2 years if you wanted to. If we were talking here about 5 years ago, 2 years ago, 3 years ago, before it actually happened. So the solution to all that is the creation, in my opinion, of a great plan, a holistic plan that takes into consideration such possibility of such events. So if you haven't done that, or you've done that but you're not sure if it's a really, really good solid plan, I suggest you have a conversation with one of our team members to help you understand what situations you're in and what could be possibly a detriment or could possibly be an issue. We do run stress tests on portfolios, and we do help people with the creation of holistic plans that can help them achieve their goals with mitigation of risk at the same time. The phone number to contact is 310-820-4411. Feel free to reach out. And by the way, if you even have a question, feel free to reach out to ask a question, and we'll see if we can help you in any way we can. Thanks again, and we'll see you around.